Good afternoon. Welcome to the Vincents October Tax and Superannuation Update. My name is Rebecca Macdonald. I'm a Director in our Business Advisory Division, and I'm joined by Alison Hines, who's a Senior Manager in our Superannuation Advisory Division. So welcome. Today's discussion is going to have quite an influence on the superannuation side of things, but also we'll start with the taxation update. Parliament have been very busy over the last quarter tabling various bills as a result of the 2016 federal budget. Some of these changes are still proposed and yet to clear both houses, but some have received royal assent. So from a taxation perspective, we're going to certainly focus on those changes, the proposed and also the legislated changes, and we'll just cap off on something a little more tame, the deductions and some hot topical areas from the ATO's perspective. I'll let Alison talk about hers when we get to the superannuation side of things. So what we might do is we might just launch straight into the taxation update. So we're going to talk firstly about the proposed changes to thresholds. Proposed meaning these particular pieces or particular bills have not yet received royal assent. Okay, so the income tax relief bill was introduced to the House of Representatives on the 1st of September this year. It proposes to increase the third personal income tax threshold applying to personal income tax payers, raising the upper threshold to $87,000 from $80,000. So the change in the threshold will also apply to non-resident individuals as well. These proposed changes are all but certain. The Tax Office in the middle of September this year released some updated PAYG withholding tables to reflect the changes in the schedules, or the thresholds I should say. So employers are actually now required to withhold at the lower amount when paying their employees, and they are required to do that effective from 1 October 2016. The Commissioner has come out and advised that any tax overpaid on that first quarter is a bit of too bad, and it will be caught up when the individual lodges their 2017 income tax return. Hopefully though that won't be too much. So that was the income tax relief bill. There was also an enterprise tax plan bill that was introduced to the House of Representatives in September. Again, proposed changes, not legislated or hasn't received royal assent yet. So still in draft and discussion version, but it is being debated at the House level at the moment. So the first proposed change is the small business entity threshold increase. And this proposes to increase the aggregated turnover threshold for eligible small business entities from $2 million to $10 million. The small business entities actually can get some access to some very good tax concessions, and they include things like immediate deductibility for small business startup expenses, simpler depreciation rules, simplified trading stock rules, rollover for restructures of small businesses, deductions for certain prepaid expenses immediately, accounting for GST on a cash basis, annual apportionment of input tax credits for acquisitions and importations that are partly creditable, paying GST by quarterly instalments, and the FBT car parking exemption. Something to note on this particular increase in threshold is that the $10 million turnover increase will not apply, or it's not proposed to be applied to the small business CGT provisions. That will still remain at the $2 million test there. One of the other measures that was proposed is the small business income tax offset, and that's available for businesses with an aggregated turnover of less than $5 million. So another offset available there. Thirdly, the corporate tax rate reduction. So currently the small business tax rate is, well, I should say currently, last year it was for 28%, reducing this down to 27.5%. And just a note there that the small businesses with an aggregated turnover of less than $10 million. There are also further reductions proposed for future years in relation to that, but I won't go into them too much because, as we all know, things can change. The idea is that the proposed corporate tax rate will be extended to all corporate tax entities by the year 2024, which is a little while away yet. Tax discount for unincorporated small businesses. So there's an increase in the small business income tax offset to 8%, with increased discounts applying in future years. So that offset was introduced in the 2016 financial year and entitles individuals who are small business entities or are liable to pay income tax on a share of income of a small business entity to a tax offset equal to 5%, with the new proposal increasing that to 8%. And that offset is actually capped at $1,000. And the cap will also remain at $1,000 even though there's a proposed increase to that percentage. Okay, moving along to other changes. I mentioned at the outset that, that Parliament had passed some legislation, and most recently the Budget Savings Bill received royal assent on the 16th of September this year. That bill seeks to achieve savings across multiple portfolios to contribute to the budget repair. Some of the key measures included in this bill, I won't go into all of them, it was quite extensive, but I will pick up on a few that hopefully are relevant for you. The reduction of the R&D tax offset rate. So the research and development tax incentive is the primary mechanism encouraging companies to undertake research and development activities in Australia. The measure reduces the rate of tax offset available under the R&D tax incentive for the first $100 million of eligible expenditure by 1.5%. So what's happening there is the higher refundable rate of the tax offset available for the eligible entities with annual turnover of less than 20 mil and which are not controlled by an exempt entity will be reduced from 45% to 43.5%. The lower non-refundable rates of the tax offset available for all other eligible entities will be reduced from 40% to 38.5%. And these new tax offsets apply, or rates apply, effective from 1 July 2016. And as I mentioned, that has been legislated now. Then we've got the indexation of private health insurance thresholds. So there was a proposal that there was a pause on the income thresholds that determine the tiers for the Medicare levy surcharges, and they've been paused at the 2015 rates and will stay there until 2021. Just a reminder that the base tier based on those 2015 rates for singles is $90,000 or less, and for a family is $180,000 or less. The fringe benefits for income tests. So there's some changes in the way that the fringe benefits are treated under the income test for family assistance and youth income support payments and other related purposes. So the meaning of adjusted fringe benefits total will be modified so that the gross rather than the adjusted net value of reportable fringe benefits is used. There's an exception for this particular definition where the fringe benefits are received by individuals working for public benevolent institutions, health promotion charities and some hospitals and ambulance services. So these changes will apply effective 1 January 2017. There's also an indexation of the family tax benefit and parental leave thresholds. Sorry, there isn't an indexation. There's actually a freeze essentially in relation to the thresholds for the higher income free area for family tax benefit Part B and the primary earner income limit for family tax benefit Part A. So they're freezing that for a further 3 years. Under the current law, indexation of those amounts was scheduled until 1 July this year, so essentially all these changes have just extended that for another 3 years. Similarly, amendments are made to ensure that the paid parental leave income limit is also frozen for another 3 years as well, so that won't be indexed. Pension means testing for aged care residents. This measure aligns the pension means testing arrangements with residential aged care requirements. Some of the key points out of these changes, that the idea is that the changes will amend the Social Security and entitlements legislation to remove the pension income and assets test exemption that are currently available to pensioners in aged care who rent out their former home and pay their aged care costs by periodic payments. The removal of the income test exemption to ensure that net rental income earned on the former principal residence of new entrants into residential aged care is treated the same way under the pension income test as it is under the aged care means test, regardless of how the resident chooses to pay their aged care accommodation costs. So that's a little bit of a no-brainer. They're just essentially trying to align those testing rules. The current, probably something that is quite important, the current indefinite assets test exemption of the former principal residence from the pensions asset test, where the property is rented and aged care accommodation costs are paid on a periodic basis, will also be removed. A person who enters a residential or flexible aged care service after the commencement of these changes, which is now, that's actually in effect, can still benefit from the former, the Security Act and Veterans Entitlements Act former residents as their principal. There's a 2-year exemption period there essentially, sorry. And that doesn't apply if your partner's still living in the house, so that only ticks over when you move out and start to rent it. There's that 2-year transition period, if you like, and following that, these new measures are proposed to remove that exemption if you continue to rent out that house. So the changes are only applying to those who have entered aged care after this date, and existing aged care residents and those who enter aged care before that date will not be affected by the changes. Sorry, I think I've misled you there. Those changes will be effective from 1 January 2017. New minimum repayment threshold for help debts. That just establishes a new minimum threshold of 2% when a person's income reaches $51,957 in the 2019 year. I think we touched on that in our last update, but that's now been legislated. The final change that I'm going to talk about in relation to the this particular bill that received royal assent is in relation to single touch payroll reporting. So the proposed changes will streamline the way employers report some tax and superannuation information to the ATO. The idea is that when an employer pays their staff, the employee's salary or wages, their PAYG and PAYG withholding amounts will automatically be reported to the ATO. Employers will also have the option to pay their PAYG withholding at the same time as they pay their staff. Although there will be some changes to how superannuation is reported to the ATO under these measures, there will be no changes to the way employers pay their superannuation. However, when those payments are being made to the employee's funds, that information will automatically be reported to the ATO. So the idea is that there's a lot more of a streamlined process in relation to information being communicated to the ATO, technologies allowing for things to transgress quite easily. So some of the important dates to remember in relation to the single touch payroll reporting is that for substantial employers, and that's employers with 20 or more employees, will be able to report through the single touch payroll regime from 1 July 2017. However, they won't be required to do it until 1 July 2018. So it's a good chance to get in and have a bit of a play and have that 12 months to establish how the system's working and iron out any glitches. Employers with 19 employees or less will be able to still use the same system from 1 July 2017. However, they're not required to do so at this stage, so it's purely optional. Finally, just on this streamlined measure, employees are now going to have access to pre-filled forms, including tax file number declarations and super choice forms via their MyGov accounts. So when they start a new job, they'll be able to jump onto their MyGov external link account and complete those forms, and that information will automatically be transferred to the ATO. The ATO will then communicate that information to the employer. So getting rid of a lot of these paper forms and communicating information electronically and where possible seamlessly, and I guess less onerous reporting measures from the employer's side if things become more streamlined. So that caps off the proposed and other changes or legislated changes that have happened in the last quarter following the 2016 budget. So I just wanted to touch off on deductions and have a bit of a chat about where the ATO are focusing their attentions. So the first thing I wanted to talk about was a recent tribunal case and the Federal Commissioner of Taxation, 2016. In that particular case, the Administrative Appeals Tribunal imposed penalties in relation to overclaim deductions by a salesman. So a professional sales commission agent attempted to claim deductions over $63,000 in his 2011 tax return and over $53,000 in his 2012 tax return for work-related expenses, including home office, various grocery items and overtime meal allowance. So some of these items that he did attempt to claim included things like toilet paper, Biggest Stringer's cheese, Weight Watchers Lamingtons. I'm not sure what the emphasis was there. It must have been a lot of Lamingtons, as well as he put in a claim for the entire family living room and alleged that that was used solely for work meetings. As you can imagine, the tribunal found that that wasn't a substantiated claim and alleged that the taxpayer and also the tax agent were unprincipled and unjustified, and that these claims were made without any merit. So the AAT ruled that the taxpayer should be subject to administrative shortfall penalties that reflected the Federal Commissioner of Taxation's claim that 50% shortfall penalties for recklessness should be imposed on some of these claims, and some were vastly worse, for want of a better word, while 75% were applied for intentional disregard of the laws. And then there was also a 20% increase for aggravating factors. So if you were to sit down and work out on a line-by-line item, it's quite an onerous process. So what the tribunal did was they used their powers and just struck a penalty, a flat rate of 11.5% for each of the income years. If you were to sit down and do the calculations, it was slightly less than that would have been calculated under those penalty regimes, but in doing so the tribunal had some good sense to make comment that this particular taxpayer had already wasted too much of our Commonwealth's resources in relation to this objection and review process, and that they weren't going to waste any more time on it. Although much of the discussion in that particular case revolved around administrative shortfall penalties issued and how they were calculated, it's a timely reminder that excessive deductions will come under scrutiny. So it's really important that we be careful about what it is we're including in our tax returns, and that we can substantiate them. The ATO has just released some information in relation to some dodgy work-related claims. Recently, they undertook a review and audit of over 450,000 2015 income tax returns, and there's a few case studies that they've issued following that review process, and highlight some of the common areas and where you might need to be careful, and again, like I said, reiterate that you ensure that you substantiate your claim. So there were two main areas were car expenses and self-education expenses that were unjustified or disallowed in various aspects. But I'll just run through three case studies just to give you a bit of a heads up as to what it is the ATO are looking for and the measures that they'll go to. Case study 1 refers to a railway guard who claimed $3,700 in work-related car expenses for travel between his home and workplace. He indicated that his expense related to carrying bulky tools, including large instruction manuals and safety equipment. The employer advised the equipment could be securely stored on their premises, and that's a really important note that affects the outcome of this particular case. So the taxpayer's car expense claims were disallowed because the equipment could be stored at the work, and carrying them was actually his personal choice, not a requirement of the employer. A little bit different to a tradesman who's got to keep his tools on site and locked away in his car. There's nowhere else to store them there. So again, it's really just pushing those boundaries a little bit too far. Case study 2 referred to a medical professional who made a claim for attending a conference in America and also provided an invoice for the expense, so presumably he paid for the conference. When the ATO checked it out, lo and behold, the taxpayer was still in Australia at the time that the conference was conducted. So again, in that particular instance, the claim was disallowed, and the taxpayer in that instance received a substantial penalty for disregard of the law there. Case study 3, a taxpayer claimed deductions for car expenses using the logbook method. The ATO found the taxpayer had recorded kilometres in the logbook on days where there was no record of the car travelling on the toll roads, and further inquiries identified that the taxpayer was out of the country at the time that logbook was conducted. Again, in that instance, the claims were disallowed. I just really wanted to run through those examples as an illustration of you can't make up or fictitiously create claims, and you really need to make sure that they are well substantiated, because the tax office will catch you. That concludes the taxation component of today's update, so I will now hand over to Alison Hines, who will give you an update on the superannuation side.
Thanks, Beck. On the superannuation side, I'm going to run through a few things for you today. I'm going to start with a bit of an update on the proposed budget changes for this year. Some legislation has been released in draft form in relation to that, so we're going to just cover off on if there's any changes from the last update and what those are. Going to have a look at the tax determination for LRBA arrangements and non-arm's length income. A couple of alerts that have been put out by the ATO recently in regards to self-managed super funds and super funds in general. Going to have a look at the increased scrutiny and releases that have been put out for self-managed super fund auditors. cover off on a couple of case studies, and then finally just want to wrap up with an article that we released yesterday. So, in regards to the superannuation budget update, these changes obviously got a lot of airtime back in May when they were released. Draft legislation has been put through to Parliament in the last couple of weeks, or mid to late September. There's a lot in the legislation. I'm not going to cover off on all of it in any great depth today because we simply don't have enough time to cover off that. We will be doing a separate webinar looking solely at the draft legislation though. Hopefully it receives royal assent before then, but if not, we will be looking at that probably next month in November. And there is also more detailed information available on our website, which was put out around, around the 27th, 28th of November, or September. So in regards to the first tranche of legislation that was released on the 15th of September, there was 4 key measures that were covered off on that one, and also a 5th which has since been removed. So the first one, the government's looking to legislate the primary objective of the superannuation system. What do they mean by this? They will be writing into the law that any future changes are required to be submitted with a statement of compatibility with this primary objective. The ultimate goal is they are hoping they can create some stability within the industry and ensure that superannuation isn't used as a budget patch going forward as it has been done in the past. What was well received, the removal of the 10% test. Currently an individual is required to show they have no more than 10% of their income from salary and wages to be entitled to claim a personal deduction for superannuation contributions. Their legislation confirms they will be removing that test, and that will just open that up to anyone wishing to maximise their superannuation contributions. It also allows employees whose employers may otherwise not offer salary sacrificing arrangements. The removal of the test will apply from 1 July 2017. In addition, the low-income superannuation tax offset is set to go ahead as well. This is effectively the same as the old system, which we have seen previously, where the payment will be made to the individual superannuation fund, and any individual who does not lodge a tax return will be assessed by the ATO after a 12-month period. Finally, increase in the income threshold for spouse contributions tax offset. They'll receive an 18% offset for contributions made. The threshold is increasing from 13,800 to 40,000, so that is a relatively substantial increase there, and it will phase out from the $37,000 mark. It will apply also to all contributions made from 1 July 2017. The final item that I've got listed there, initially in the first tranche of draft legislation that was released, confirmed that they were removing the work test. They have since backtracked on that as a consequence of changes to some of the other initial proposed measures. So the work test will not, the removal of the work test will not go ahead. So individuals in that age bracket 65 to 74 will still be required to work 40 hours in a 30-day period to be eligible to make contributions to superannuation. The second update that we've had in relation to the proposed budget changes was on the 27th of September 2016. This second tranche of legislation was much more in depth. They provided us with a greater understanding on how the proposed transfer balance cap is going to work. This in particular I'm only going to cover in a high level as there is a lot. The explanatory memorandum that was released with the legislation purely in relation to the transfer balance cap covered 70 pages. So when we do an additional webinar, that will be a large focus for us. The the legislation does put out and say when a member transfers their balance into retirement phase, the operation will be similar to a theoretical bank account. It will include debits and credits, which will allow a member to roll their balances and for commutations to be recorded. So that was a big question that was immediately put out when the proposed changes were announced back in May. There were a few additional interesting items that came through with the legislation that the government has considered based on previous feedback. The legislation proposes to remove the tax segregation method for claiming exempt current pension income, where at least one member of the fund has total super balance of more than 1.6 mil, and they are in retirement phase. So what this means is that if an asset is segregated to a particular member and any member in that fund has a balance of more than 1.6 mil, then the calculation of the exempt pension income won't simply be the income on that asset is exempt. It will actually be a proportional method, and that actually may end up differing from what the income allocation is for the fund. So the income that's allocated to that member's account could end up being different. In addition, the government also recognised that members currently in retirement phase may need to move assets back to accumulation phase to be able to move their pension balances down below the $1.6 million cap, and in doing so they may be liable for future capital gains tax. To try and offset that, they are offering to those members that prior to 2017 they can reset the cost base of their CGT assets to be what it is at that date, so it needs to be market value obviously. If an election to reset the cost base is done, then an apportionment is also required, however, for any assets currently in a hybrid fund that may have a partial CGT event. So if we have a fund that currently has members a $2 million pension account and a $1 million accumulation account, that fund is classified as hybrid fund. It already will be paying some level of capital gains tax. If those assets need to be moved back to accumulation phase to reduce down below the 1.6 mil, so we're taking from the 2 mil down to 1.6, we'll have a partial CGT event on the sale, not on the sale, but on the deemed sale of the reset of the cost base of that asset. They are offering that capital gain, however, can be deferred. So it will be deferred to the sooner of when you sell the asset or 10 years. So that'll be an election that you make, and it'll mean the records of the super fund in that case will need to reflect that. The second tranche of legislation also touched on concessional contributions. So the concessional contribution cap will be reduced to a flat $25,000 regardless of an individual's age. This cap will be indexed in amounts of $2,500, which should see more frequent increases in the cap. Both from 1 July 2017, the Division 293 tax threshold for high income earners will also be reduced to $250,000. Further, the concessional contributions made to a constitutionally protected fund will be counted towards a member's concessional contribution cap. While these members still will not receive an excess contributions tax notice, it just means that where they exceed the cap, they will be no longer able to make any top-up contributions. And I suggest that measure is to avoid against any loophole that may coincide with the removal of the 10% test. So by counting those contributions towards that cap, those people can't then subsequently take advantage of the removal of the 10% test and put in another $25,000 up to the cap. The catch-up of unused concessional contributions for members balance less than $500,000 has been deferred. It will be first utilised to calculate a member's cap in the 2020 financial year, but otherwise, in terms of the draft legislation, is still proposed to go ahead. Finally, the last items that the second tranche included was the removal of the anti-detriment provisions. This was being confirmed to apply from 1 July 2017. In addition, consistent with the new transfer balance cap, a transition to retirement income stream will no longer be known as a retirement product or as a to be in retirement phase. So the draft legislation removes the tax exemption inside a super fund, meaning that any balance which is in a transition to retirement pension is effectively taxed the same as if it is in accumulation phase. On a flip side, because these amounts are no longer classified as being in retirement phase, they will not count towards the transfer balance cap. So when we look at the transfer balance cap in more detail, we'll cover off on that. But that is one of the exclusions that they have listed in there. From 1 July 2017, members will no longer have the ability to treat a pension payment from either a transition to retirement income stream or an account-based pension to be a lump sum for tax purposes. When the initial budget announcements were made, it did not specify whether that was going to be an exclusion for transition to retirement pensions only, but the legislation confirms it is for all types of pensions. It doesn't exclude members who meet the criteria to make a lump sum from their pension for doing so. So if you are drawing an account-based pension, you still have the ability to access the capital of that account. You need to just do so in addition to meeting the minimum pension requirement. So any lump sums can be taken above the minimum pension. While the new legislation in regards to the non-concessional contribution caps were not included in either of the first two tranches, they have been proposed to be released soon, so I'm expecting that we will see them shortly. They have, however, released a fact sheet. It sets out that the new non-concessional caps is expected to be $100,000 or $300,000 brought forward over a 3-year period. There will also be a transitional bring forward cap which applies for members that trigger their bring forward in either the 2016 or the 2017 financial year. So you will not receive the current 540 cap that we are operating under now. It will be the 180 for the relevant year in which you've triggered it, and then in the 2018 financial year, the maximum will be 100,000. So it'll be a bit of a prorated cap, if you can call it that. So that's the summary of the draft legislation that we've seen. I expect that once we have seen all of this all comments are taken and the legislation is passed, there'll be an increased need for trustees to review their deeds, make sure that they are compliant with current legislation and any changes that they can take advantage of them. In addition to that, you may be aware we've transitioned to Class Super for the administration of the funds. Class Super offers a client view access for trustees and advisors of funds. We're expecting over the next couple of years, with the introduction of these measures that are being put forward in front of us, this will offer significant advantages for tracking contributions and pension caps. The ability for ourselves as administrators, trustees and members of funds and advisors all to be logged in and see the same central information. Everyone's on the same page, should provide for a valuable tool. So moving on, just going to have a look at a recent released tax determination 2016/16. This determination looks at limited recourse borrowing arrangements and expands on the information the ATO put out earlier in the year in regards to the safe harbour provisions. In the tax determination, the ATO have reiterated that income received from a non-arm's length LRBA arrangement will be classified as non-arm's length income, or they term NALI. NALI is taxed on the net position, so that's the income less the expenses relating to that particular income, at the top marginal rate inside the fund. So the tax is still paid inside the fund, you just do not receive the concessional 15% tax rate. In tax determination 2016/16, they consider that in addition to the previous information, what is the next step if you do fail the safe harbour guidelines. So they've introduced this concept of what would the fund have done and what could they have still done. Would they have still entered into the arrangement if the circumstances had been different? Easiest to talk through this, explain by way of example. So a situation where self-managed super fund acquired a commercial real property from a third party at a market value of $1 million. The fund receives rental income of $1,000 per week. The property purchase was financed under an LRBA on terms consistent with the Act at the time. A holding trust or a bear trust was established, and that trust is the legal owner of the commercial property until the borrowing is repaid, so as required under the law. The lender is a related party to the self-managed super fund. At the time of the transaction, the super fund had an amount of $25,000 cash at bank. They had no other assets at the time of purchase. The self-managed super fund investment strategy specifies a diversified asset portfolio between cash, listed shares and property. So what does that look like? In the middle column there, you can see against each of the safe harbour criteria how our situation falls. So I've borrowed $1 million. We have contributed no capital. We have a 0% interest rate. The terms of our loan are 25 years. Our loan-to-value ratio is 100%. There is a mortgage which has been registered in favour of the lender. No personal guarantee has been provided and no repayment is required until the end of the term of the loan. Sounds like a pretty good deal to me. Over on the right we have the safe harbour criteria. So we can see by comparison we should have borrowed $700,000. Amount sourced from fund capital would have been $300,000. Variable interest rate of 5.75%. 15-year loan term gives us a loan-to-value ratio of 70%. We would have a mortgage registered. Personal guarantee would not be required. However, we would be able to pay monthly repayments of principal and interest of approximately $5,800 per month. That's calculated based on the loan amount and the variable rate of 5.75%. So under this situation, you can see the loan-to-value ratio of 70% required the self-managed super fund to come up with $300,000 of its own funding to make the purchase. The weekly rental of $1,000 per week would not be sufficient to meet the monthly repayments of principal interest calculated on $5,800 per month. And it's assumed the super fund would not be in breach of any other legislation requirements. So everything else ticks off. It's just this criteria that we don't meet. So what the position is in relation to this, based on the facts above, it's clear the self-managed super fund could not and would not have entered into the arm's length hypothetical arrangement. Conclusion is based on the fact that the super fund did not have sufficient funds available to reduce the level of borrowings to finance the purchase, to satisfy the 70% loan-to-value ratio, and the hypothetical borrower arrangement, taking into account the weekly rental and any future capital gains, would not be earnings positive. So what they're really looking at, while this is an extreme circumstance, they're saying purely based on the facts at the time of their transaction, the fund would have needed to source additional capital from either rollovers or from cash contribution for the members. And even then, had they been able to do that, it still is questionable whether they would have met the monthly, the repayments and the cash flow funding for the arrangement. So if the fund had have gone down to a bank to obtain finance in this circumstance, it's probably not likely that they would have been able to do so. So the would have and could have tests is something that when reviewing these arrangements, we still have a transitional period of until January to be able to get these arrangements compliant with the safe harbour criteria. We'll make a decision if we're happy for them not to comply or what needs to be done to be able to comply. So the would have and could have arguments are going to become relevant as we look at those over the next couple of months. Moving on, the ATO has been, I guess, moderately quiet. There hasn't been a lot of information that has come out of them, and I think part of that has been as a consequence of the budget. Invested considerable time into the $500,000 non-concessional contribution cap, which was then removed by the time the draft legislation came around. So I think they would have just been too preoccupied with everything else that's been going on. What they have put out recently, though, is just a couple of friendly reminders. Contribution reserving strategy, where a member may contribute money to a fund in June, claim that deduction upfront in their personal return or in their business, and that contribution is then allocated in the fund in July. So it counts towards the future year contribution cap and not the year in which it has actually contributed to the fund. The ATO asked that that is reported in their annual return in a specific way. So all contributions are required to be reported in the year they were received and not in the year they are allocated. So in that situation, if it is received in June in cash in the fund, it is reported in that financial year end. The means of ensuring that you do not receive an excess contributions tax notice is by the preparation and submission to the ATO of the request to adjusted concessional contributions form, which is an ATO approved form found on their website. So a reminder from them that the 2 steps that need to be undertaken to ensure that everything is kosher. Also, electronic service address. All self-managed super funds are required to have an active ESA for receiving superannuation payments. So in particular, contributions, however, payments from other superannuation funds as well. Their recommendation is to ensure that the self-managed super fund trustees confirm with their provider that the ESA is actually active before its first use. If the ESA is not active, then the contributions simply may not be made to the fund, so they may not be received. I think they are receiving a few instances where there's conflicting information at the super fund end as to what the member is providing to their employer, and contributions are going missing as a result. In addition, in a recent speech made by the ATO, they have put some warnings out there for self-managed super fund auditors. So what they are looking at, just a warning for any auditors who are advertising a combination of these items listed below. So one of these in its own right may not result in any action, but a combination of these may find a phone call from the ATO or ASIC on hand. While the Commissioner didn't, or Deputy Commissioner, sorry, didn't discourage the use of automation in her comments, they were merely a reminder that the automation can be utilised to perform the financial checks, and the auditors are still required to use their skill and judgment to address the regulatory issues arising from the superannuation legislation. So we can use the automation, we can check off the balance is correct, that there is some, everything agrees for listed shares, for bank accounts and those types of investments. However, that doesn't stop the auditors from being required to review those transactions, make sure there's no related party involvement, make sure the ownership of those assets is all still correct. So that requirement is still present and still very strong. The Deputy also spoke about reciprocal audits where you may have a situation two people audit each other's funds. They did question if it's possible to safeguard against the threats in this situation, and they will be picking up on those situations and having a closer look at them. There have been a couple of interesting cases that have come out in the last few months. So just going to cover off on those. One is a payroll tax case, and then the second is in regards to the issuing of penalties for a self-managed super fund trustee. So in our first case, we have Miss Bird and Mr. Scott. They are trustees of a self-managed super fund. They are also directors and shareholders of Newcastle Group. They have a self-managed super fund, two properties located under a limited recourse borrowing arrangement. One of these properties was leased entirely to the Newcastle Group. Newcastle Group was issued with a payroll tax assessment totalling over 2.6 mil, so quite a sizable liability. The self-managed super fund and the custodian trust did not have any employees and did not carry on the business in any sense. So they were definitely, by the letter of the law, a self-managed super fund, and the trusts were pure holding trusts for limited recourse borrowing arrangements. In this case, payroll tax, the definition of a business includes a trust, a carrying on of a trust, including a dormant trust. So that trust isn't actually required to be carrying on a business. Business must be carried on independently of and not connected with the business of a business by any members of the group. So there can't be any form of connection there. In this situation, one of those properties located in Queensland, as I mentioned, was leased to an entity in the Newcastle Group. In the decision that was made in this case, the individuals of trustee of the self-managed super fund and the corporate trustees of the Bear Trust are considered joint and severally liable for the payroll tax liabilities. So the application was rejected to have them excluded from the group. Therefore, they are personally liable. In making the decision, emphasis was placed on the fact that the business carried on by the taxpayers was not independent and was connected with the business of the group. The court noted that the Commissioner had evidence in the form of an email from the Newcastle Group accountant suggesting that the lease of the property to an entity in the group was not on arm's length commercial terms. So by not acting on arm's length commercial terms, it could be implied the self-managed super fund structure was being used to move the money away from the business into the concessionally taxed environment, and also in this case has had the ability to discharge their payroll tax liabilities because there's less funds available in the businesses. It is interesting, or you do question whether if the fund's operations had have been on an arm's length basis in terms of the lease to the related party, then would there have been the same outcome in this case? Not necessarily a yes or no straightforward answer, but definitely something to consider. It is probably important to note too that there was obviously a transaction there, or a situation there where there was a related party transaction going on. So this doesn't mean that every individual trustee, every Bear trustee is going to be liable for payroll tax. I think the related lease between the fund and a related party is definitely a considerable factor. In saying that though, obviously widely known protection for individuals to be personally severably liable is to have a corporate trustee in place, so that's always encouraged for the self-managed super fund. Almost done. We should be almost on time. So final case I have for you is Mr. Mr. Rodriguez and his wife. They established a self-managed super fund and rolled over his benefits. In the same year, they withdrew $111,000 from the fund as a loan to Miss Misen, which was perpetrated to be on terms of an arm's length commercial arrangement. Subsequent to that, withdrawals were made in the 2006-07 financial year to purchase gold in the self-managed super fund. When these assets were later sold, the proceeds of that sale were deposited into Mr. Rodriguez's personal account. During 2008 and 2009, on a further 6 occasions, some of the money was repaid to the fund. In addition, though, more withdrawals were made. A total of 32 withdrawals were made from the fund during the period 1 July 2009 to 30 June 2013, and some repayments were made during the 2010 financial year. So over a period from 2005 through to 2013, while all of those years were not able to be contested because some were outside the 6-year time frame, we do have obviously a considerable time period with repeated behaviour of taking money out of the fund. When it came time to prepare the accounts for the 2011 financial year, the auditor for the self-managed super fund lodged a contravention report, issued a qualified audit report for the self-managed super fund, and it was consequently selected for an audit by the Commissioner in February 2013. The trustees, upon learning of the ATO audit, subsequently repaid the remaining loans, including interest, on an arm's length interest rate by way of in-specie transfer of shares back to the fund. During the audit, he also voluntarily disclosed to the ATO that the loan we had initially back in 2005 for $111,000 was fabricated. The money was actually paid to himself. As a consequence, throughout this, the ATO found that the fund, and Mr. Rodriguez also acknowledged that the fund was in breach of Section 62, which is the sole purpose test, Section 65 being financial assistance to members, and Section 84 being in-house assets of the SIS Act. Penalties of $40,000 were imposed on the trustee, and the contraventions were held to be serious as they involved dishonesty over a substantial period of time, as I mentioned earlier. In this case, the court considered that the contraventions were serious and warranted a penalty as they involved deliberate breaches and dishonesty over a substantial period of time. In imposing the penalty, the court took into account mitigating factors such as the fact that the trustee had fully cooperated with the authorities. The trustee has also subsequently been barred from acting as a trustee of a self-managed super fund in the future, so they have been disqualified. However, the court also found that there was dishonesty associated with the fabrication of the loan and the loans achieved via the purchase of the gold bars, which were all designed to avoid the scrutiny of the fund's auditor at the time, to cover up what they'd actually genuinely done. So while Mr. Rodriguez tried to make good by repaying all the money in the fund, admitting he's wrong, etc., he has still been imposed penalties of $40,000. So the ATO is cracking down on that. They are acknowledging you have repaid, but it is still taken very seriously. Finally, for me, last thing I just wanted to cover off on. Yesterday, or only this week, on our website an article was released. We have noticed an increase in the number of self-managed funds investing in unlisted trusts and company. So did think it was prudent to address with those people. Just be aware of what the consequences of those types of investments are. While most are legal and within the means, particularly startup entities, they attract a potential higher return in the longer run, and sometimes the initial outlay isn't significant, so I can understand the attraction for members wishing to invest. A few key takeaways from the article. These types of investments are a higher risk type of investment, so they are likely to attract compliance audit by the ATO. So there's means which you can insure against that, but something to be aware of. Further, as part of the administration and audit work for the fund, on an annual basis we are required to look at the related party involvement in all levels, so whether it be at a transactional level as to what's actually going on in the entity, or at who the directors, shareholders, trustees, investors, unit holders, etc. are of the fund. So also required to verify the market value of the investment and that the investment complies with the fund's investment strategy. And these situations arise every year regardless of whether you had made the same inquiries in the prior year. It needs to be made again in the current year. Information for these types of entities is often not readily available, and therefore completion of annual accounts and audit can sometimes be a bit more onerous. That's for both the trustees, the members, the administrators and the auditors. So I guess the key takeaway are be aware there is more work involved with these investments, good record keeping, and the basis for all decisions undertaken by trustees is going to assist in any situations where there is a higher risk of a compliance audit from the ATO.
Can get some advice, hey Alison?
Absolutely, before you invest.
Excellent. I think we've just a fraction gone over time here, so unfortunately we won't have time for any questions, but if you email them through, I know both Alison and I would be only too happy to get back to you. So thank you for listening today, and that's a wrap.
Excellent, thank you.